Okay, so this is a recording line. Hello, everybody. Welcome to the webinar. My name is Sarah Grillo. It's me, Sarah G, with the SMAC, and I am back. And today we're going to be talking about how to rock advice only, hourly, and flat fee financial advice. Woohoo! Now, I've got a really good crew here, but I just want to make some basic announcements beforehand. This is a recorded line. So if there's any issues with anybody being on a recorded line, please kindly exit the webinar. A replay will be available and it will be emailed to you later this week, maybe even today, if I could be quick as a flash. Who knows? There's another webinar in this series. In order to support this movement towards more transparent and ethical financial advice, I'm going to be trying to have webinars as much as I can. The next one is on June 7th with Scott Selaski and Eric Simonson. I have a newsletter that you can join where I'm going to be publishing information and resources that will be helpful to you. And I also have a LinkedIn group that is specialized in discussions in this area that anybody is welcome to join. You don't have to be a flat fee hourly or advice only advisor. You just have to be interested in the conversations, or if you want to lurk and just absorb, then that's cool too. Just want to talk a little bit about accessibility. First, I just want to apologize for not clarifying this before the webinar. This is an inclusive environment. As much as possible, I want to make sure that everybody, regardless of their status, is included. So if anyone has issues with seeing, is blind, deaf, lost a limb, has information processing difficulties, etc., please, if you're unable to access this webinar, please let me know, and I will make every accommodation that I can to help you to access the replay. Or send me a chat message during the webinar if there are accessibility difficulties as well. And again, I apologize for my oversight in not acknowledging this in the questions before. So the speakers that we have for today are Jamie Menges, flat fee advisor. He's going to talk about how to convert a firm from AUM to flat fee. Hello, Jamie. Woohoo! John Luskin, hourly advice for do-it-yourself investors. Andy Panko, flat fee advisor. And Richard Chen, Richard Chen, an attorney for financial advisors. Just for the full disclosure, Richard is actually my attorney. I just wanted to be clear about that. You know, that's not necessarily why I asked him to be on the webinar, but he is not my client, I am his client. And then Cody Garrett, advice only financial advisor. And what is advice only? He's going to talk about that as well as other things. So this is the list of questions. I'm not going to bore you with them because I hate being bored myself. So far, there's just one question from the audience: what to do for an abnormally large account if you are handling as a flat, hourly, or AO advisor? What if you have a $50 million asset account? That is the one question. So speakers, please address this in your words, and let's get started, everybody. So Andy and Jamie, please, and by the way, all of the information about the replay and about the newsletter and about the LinkedIn group, I'm going to be emailing that all out afterwards. So don't worry about it. You don't have to worry about that now. Andy and Jamie and Richard Chen, if you're here, please unmute yourselves and start talking.
All right, great. Andy, you want me to go first, or you want to lead off?
I'll start, since I'm, I guess, the start a flat fee firm, whereas you're the convert, if that's okay. And feel free to just jump in. There's no formal structure to this, not super regimented, but quick background. I was in institutional investment management, risk management for 19 years prior to quitting that world and starting my own fee only, retirement focused, flat fee firm. I thought about this a lot, having worked in the industry, having been in and around % of assets under management for a better part of 20 years. And as a consumer, I won't get too off into it. I mean, I think most of you who are aware of me know I have very strong feelings about this, but I just realized we as an industry are better than this. The % of assets under management is kind of arbitrary, silly, mutually unfair. There's lots of other words I can use, sort of way to come up with the dollar amount of fee for a professional service. So I'll leave that there. So I was, as a consumer, realized if and when I do this, it's going to be under a flat fee structure where the dollar amount of fee isn't based on size of assets. So that's the background. That's how I came into doing what I'm doing. And when I was starting my firm, frankly, the mechanics of starting a flat fee firm really aren't different than starting a traditional fee is based on percentage of assets firm. You still need to start an LLC if you want to. I mean, you can do it as a sole proprietor, I guess. You have to get registered. Assuming you don't already have $100 million of assets under management to start with, you'll need to be registered at your local state in which you reside, and any other states where you have a certain amount of clients. There's a de minimis rule, et cetera, but at least your home state. So you have to go through that. You need a website, you need your processes figured out, you need a custodian. It's all the same stuff as if you were to start your own RIA as a percent of assets under management. Functionally no different in all that. What is different, obviously, is the dollar amount of fee you charge and how you derive it. I know this isn't really the focus of now, but how do you come up with what an appropriate flat fee is? First, kind of start with the clients that you want to work with, the typical life and financial circumstances that client will have. If you're trying to be all things to all people, flat fee is probably not going to work, because you're going to have people with 50 grand of assets they want you to manage and super simple lives. And then some people with, 10 million and God knows what going on in their lives. That's not going to work. Why flat fee works for me, and why I think it can work for a lot of folks, is I have a very clear focus of who I wanted to work with. The typical sort of pre-retirees, retirees, nothing overly complex. I don't deal with anyone that has international angles. Special needs planning I don't do, because I realize that's a whole separate area of specialization that I'm not an expert in. Business owners, a lot of advisors, they say I work with business owners and high net worth families. I don't want business owners. That's a whole separate ball of wax, and flat fee is not going to work there, because it depends on how complex the business is and whatever. So mine is just a traditional, most people are W-2 wage earners, whether they got $1 million or $5 million, it doesn't really matter. The planning I do is the real value. Roth conversions, IRA distributions, helping with Social Security pensions, whatever. Investment management is really just a sort of mechanical process. Now I am a passive index-based, keep fees low, do proper asset location kind of guy. But whether it's $1 million or $5 million, it doesn't matter. It's the same amount of analysis and work and processes I'm doing. So flat fee makes sense for me and what I do. One of the questions is, what do you do if you have a $50 million account? I would flat out say no to it. I realize there are limitations to flat fee, one of which, look at the extremes. Client has a $100,000 portfolio. There's no way they're going to pay 6 to 10 grand a year in flat fee when they can go to the run-of-the-mill 1 to 2% of AUM person down the street and pay, $1,000, $2,000, whatever it may be. On the flip side, someone with $50 million, they're going to be more complex. If for no other reason, they're already over the estate exemption limit. So there's going to need to be some creative use of estate planning, insurance use, gifting, more hair to that than the typical few $1 million account clients. If someone's got $1 to $3 million, it's, asset size alone has no bearing on what you're actually doing for them, or the time or resources or expertise. When you got 10, 20, 30, 40, $50 million, I don't touch that. I sort of draw a soft line at $10 million in net worth. Again, assuming that net worth is mostly traditional stuff, not crazy alternative investments or businesses. That's not my bag. So in my case, it wouldn't work. Nor do I want that to work. I sort of pick clients where what they want, what they need, the value I can provide fits the flat fee that I charge. Outside of that, I've referred away more prospects and I've taken on as clients because they weren't the right fit for what I do, how I do, and what I charge. So I'll pause there for now. The starting it is really straightforward. It's just how you derive your fee is the only real difference between this and a normal percent of assets under management firm. Jamie?
Great. Thanks, Andy. I think that's a great point about the way you've managed your niche marketing. And so when I think of flat fee, I'm not thinking of the niche side of it where everybody really shares the same fee. For us, a flat fee is it's derived based upon an internal pricing formula. And I'll talk a little bit more about that in a moment. So we do work with probably a wider spectrum of clients than Andy alluded to. So for us, we were a firm that the firm I own is 37 years old. I'm obviously a second generation owner, and our founder worked with a lot of his friends and just close network to get the business started, like anyone would. And because of that, I think we had a lot of clients who weren't paying us a great deal of money, because any revenue was good revenue when the organization started in 1985. And so as we started to look at this, like how we were pricing clients, profitability, what we really believed in, and where we wanted to take the firm next, we were working with, at the time, we had two ways we charged clients. We had an AUM fee for clients. And then for some clients, we had what we called a retainer model. And it was what looks like the early version of a flat fixed fee, but we didn't have any conviction in how we were pricing people. And I told Sarah this in a private conversation that, we would ultimately run it through our pricing formula and then say to ourselves with imposter syndrome, well, they'll never pay us that. So then we would just back into what we thought they would pay us. It was horrible. And it really wasn't getting us where we wanted to go as an organization. And so I would tell anybody who's thinking about making this conversion, there's really three big steps to the decision cycle. The first part is the why, and I'll talk about what we concluded. Then there's the how. So how you're going to actually make this work with existing clients, because unlike Andy, we weren't working with a blank canvas. And then measuring the results and evolving the process from there. So for us, the why was, there were really four pieces to it. It was a belief that this is the right way to charge clients, much like Andy said. Whether you have $1 million or $5 million, generally speaking, that's not a marker for complexity or time. We needed something better than what we currently had in our mix of AUM and retainer. As I mentioned, we didn't have a really good, strong formula at how to arrive at the fee that we wanted to charge somebody. So when we delivered that to them and said to them, not just this seemingly marginal, well, we just charge 1% of assets. When we said, we're going to charge you $8,500 a year, people take that and they go, well, there goes the Disney vacation, or there goes fill in the blank, something that they were going to purchase. And so it gets to become a real struggle for them. And if you're not delivering it with conviction, how can you expect them to want to buy into that? So that was the second thing, was we needed something better than we had. The retainer wasn't allowing for a consistent application across the board. So we thought that actually had some compliance issues for us too, from a regulatory standpoint. And then because, as I had mentioned, we weren't charging clients that much, we thought that this would actually allow us to charge more money over the long term, and not charge more money per client, but just earn a more fair fee for the work that we were delivering, because we do extensive financial planning, tax planning, projection modeling all throughout the year. So that was kind of the why for us. So if your firm can get into the why this is good for you, that's step one. Then you got to figure out the mechanics of it. So for us, we wanted to make sure that we had buy-in across the entire team. So we're an organization of 15 people. We wanted everybody to understand why we were doing it and why it made sense. The buy-in was immediate for a lot of the reasons Andy mentioned. We also then went out to our centers of influence, and we wanted to make sure we had buy-in from them. Hey, this is what we're thinking about doing. Here's why we think it makes such, sense. Give me your feedback from that. When you hear that for the first time, let me know what you think, because there's not a lot of firms our size doing this. The buy-in from the COIs was, well, gosh, Jamie, that's completely obvious. And then, we built what was the initial bones of our pricing model. And originally we had clients who came to us and just needed asset management only. That was kind of on a separate scale, flat fixed fee for that. And then we had 3 tiers of planning. And for us, those were just basic, moderate, and complex. And we basically tried to get clients positioned into each of those groups. And then inside that, there were just some pricing bands that we had used. We've since evolved that to something that we think is a little more appropriate in terms of what service model does our client need? Do they need asset management on the one end, and they just need us to manage portfolios? So think of a not-for-profit or an extremely wealthy family, for example. On the other side, and I'm talking about wealth where they have like family office type wealth. So they've got all the estate planning and tax folks right there working alongside them. They don't need us to tell them they're on track for retirement. They just need us to manage, be good stewards of their money. On the other side of that, you got like our comprehensive wealth management clients, and they need proactive, regular meetings, consistent application of our services through some complex planning issues that they have. In the middle, then we identified this target, and we call it foundational planning. And these are folks who they just need us to help them chart a course and then give them the 4 or 5 things they need to do on a consistent basis to have financial success. Each of those have their own set pricing model, but inside the comprehensive piece, we break it up into basically modular planning. And I'm going to just rattle those off. So we have asset administration and management, phone and email support. So this was a way for us to price some of our time in from a service perspective. How many meetings are they going to have? Do they want written reviews on top of that? Is there investment analysis that needs to be done beyond the normal allocation and security selection stuff? Concentrated stock, embedded gains, et cetera. Do they have stock option programs that they participate in? Because, that's something that takes a considerable amount of time. Are we going to do a full-blown tax projection for them? Or are we going to just draft off of what their CPA is already doing? Is there multi-generational planning that goes into this? And are they using multiple custodians? Schwab is our preferred custodian. We work with several others, but that creates a level of complexity that we have to deal with. So all of those things go into the pricing of how we price something. And I think once you determine what's going to be your mechanism by which you price things, and you've got the why, you now have the how. The conversation of converting clients to that was pretty seamless. For those that had to get a price increase, we said to them, look, we've looked at the service model we're providing. This is what we believe to be a fair and adequate price for the services we're going to give you. It's as a fixed fee. So as you continue to contribute or market appreciation occurs, that doesn't matter. If you inherit money, that's not a change in the scope of the work we're doing. So your fee is able to stay the same. For those that the fee was coming down, obviously that was a really easy conversation to have. So for us, the how was, about a 2-year process to really get to where we wanted to be. And we are essentially 100% fixed fee now. And if you look at our ADV, you'll still see that we have some grandfathered clients under the AUM. Those are all being worked off. There's just a handful of unique circumstances that we're just trying to get some of these organizations to the flat fee ground. The results, and I'll just recap these real quick and I'll be done. The growth has been considerable for us because the message has been well received. If somebody comes in our office and is already working with an advisor and they're on an AUM model, and I explain what we're going to do for them, and then I tell them, let me tell you how we're going to price this relative to how the industry does it. Before I conclude that, anecdotally, it's like 95 out of 100 are reaching for a pen. They're ready to go because they get it. The average client size from an asset basis has gone up because they realize the greatest benefits in this. The average client agreement size, so our revenue model, that's gone up. And it's largely predictable for us as an organization. So flat fee, that's the great thing about it. You're no longer subject to the whims of the market. There have been challenges standardizing the increases over time. So how do you have the conversation with clients on an ongoing basis about needing to increase it or adjust their fee based on the cost of doing business? Because our cost of personnel, our overhead continues to go up, technology costs, et cetera. So we've got to account for that. And then challenges around, are we charging enough for really complex clients? So now $50 million probably goes outside the reach that we handle at our organization. So we would actually refer that to a firm, flat fee firm as well, who works with some really ultra high net worth folks. But when we get into these higher net worth things, I mean, you just have to get out of the mindset that that's the elephant in the room. It really makes the earth pretty flat in terms of your client base. And so no client can really undo the economics of the organization. And that's a great feeling. At the same time, when a $50 million client walks in the room, I think to myself, can I price them well enough that's going to account for all the time that we're going to have to put into that? But I just think you have to get past that hurdle that one is different than a $5 million client, because on a flat fee basis, that's just no longer the case. So for us, if I were to grade whether or not this was a good decision for us, it absolutely was. We've really enjoyed talking about it. And we're one of the few organizations of our size that's out there doing this from a flat fee perspective. So I'll go dark now and let the show continue.
Thanks. I just want to say it's great to see a firm of your size, of your scale, doing this. Some of the criticism I've gotten and some of the personal swipes I've gotten from folks about my vocalness about this is, well, yeah, great. It works for a solo shop or a small shop. It's never going to scale. To which I say, well, why can't it? I'm charging $8,400 to $9,600 per relationship. What's the average percent of AUM advisory relationship? Average revenue, $7,000, $8,000, $9,000, maybe some are higher, some are lower. But if the average client revenue is X amount of dollars per client, and my average is higher than a lot of other advisors, why can't it scale? right? It's
Yeah.
that simple. That the fact that the fee amount, the dollar amount of fee is different than the variable amount you have every quarter, the percent of AUM, doesn't mean it can't scale. You're a case in point. So thank you for sharing. It's great to see a larger firm doing this and doing it well.
Yeah, thank you.
All right, now Richard Chen's going to talk about the legal aspects of being a flat fee advisor.
Yeah, thanks, Sarah. So there are a variety of issues to consider when you have a flat fee arrangement. And one of the huge benefits is that you actually get out of a ton of regulatory risk. One of the issues that's increasingly an issue for the SEC now is fee billing. It's been a priority, and where you have asset-based fee billing, you run into situations where there are challenges, right, with respect to valuation of assets, which potentially has a conflict of interest, including just complications, right, with additions and withdrawals or tier feed schedules or householding. You don't have those issues with flat fee billing. It's a very straightforward process that eliminates a lot of the conflicts that the SEC is focused on. Now, one of the concerns that many folks have when they think about flat fee billing is, am I locked into this arrangement in the long term? And the answer is no. There are a variety of ways that you can build in flat fee adjustments to deal with inflation or changes in scope of services that we'll talk about now. In order to deal with inflation or other sort of desires to raise prices, well, at least with respect to inflation, you can build into an agreement a price escalation adjustment that's based on a benchmark or a set percentage on a year-by-year basis, or however you choose to do that in order to deal with inflation. If you want to deal with price adjustments on a discretionary basis, or a change in services, the best way to do that in your agreement is to make sure that you have the ability to terminate an agreement if you want to on short notice. And that allows you to basically provide the clients with a heads up that we are going to change the fees, and assuming that they are okay with it, then it will continue. But if it doesn't, it allows you the opportunity to end the engagement without being locked in. So that's important, to have termination provisions that are friendly to you, that allow you to adjust as the business grows, even if you have a flat fee arrangement. There are other provisions that you can deal with, allow you to amend an agreement without client consent. However, generally speaking, I would probably not recommend amending a fee in an agreement without having the client being able to sort of sign off on that. That's why I think that the early termination provision is more protective. But these are ways that you can. Well, that's a good question. It was asked about what's short term. I would say even less than that. We have agreements that basically allow the advisor to terminate immediately upon notice. And now, from practical sort of client relationship perspective, you probably won't be doing that, but it allows you that flexibility to do that. So that and many advisory agreements are built that way, where the advisor has the right to terminate immediately upon notice. Now, a couple of things to think about in terms of your flat fee arrangements: make sure that even if there's a flat fee, you indicate when the payments will be made and on what frequency, right? So that you make sure to cover those terms as well, because it's important to know if there's going to be any amounts that are upfront, or if everything's going to be back-ended, or a combination of the two. So those are a few things to think about when you are putting together your agreement for flat fee billing.
Richard, somebody asks, termination provisions short term, 30 days, what would be considered short term?
So Sarah, yeah, I think basically short term is immediately upon notice, and that is very common in advisory agreements. Often that's basically what we draft for our clients, regardless of the fee arrangement, whether it's flat fee or assets fund management. We basically allow for advisors to terminate immediately upon notice to the client.
This would conclude the speaker portion of the flat fee advisor segment. I'm pausing now for questions. Please either chat in or go ahead and fire them out. Unmute yourself and fire them out.
So I see a question here from Brenna addressed to me. With the demographic you're serving, pre-retirees and retirees, how many also invest their assets with you? Do you charge them nominal basis points for the administration? Oh, a great question. And I sort of take for granted, I only do relationships where I am managing investments under discretionary advisory relationships. I'm not planning only, I'm not advice only. That's the latter half of this thing. So I'm doing everything a traditional percent of AUM advisor does with, the real focus on planning, but also managing investments. That's no different. The difference is the dollar amount of fee I charge is fixed. Whether a client has $1 million or $5 million, my fee is what it is for everyone. Now, I do have discretion in my ADV. I have a really wide range from, I think, $3,600 a year to $36,000 a year. But I just stick to, everyone's at 8,400 or 96 if you're single or married, and I only pick clients where that fee sort of makes sense. I'll turn away more complex. I'll turn away people who aren't going to see the value, or frankly, have too small of asset size where my fee would equate to like 4 or 5% of AUM, in which case I'll say no, and I'll refer them to other folks I like and trust. So yes, I do manage investments. It is not scaled on investment size. Dollar amount of fee comes out every quarter. Like you said, Richard, makes it really easy. I don't have to worry about average daily balances or whatever. My $9,600 per year clients are charged $2,400 per quarter out of their accounts. That amount is prorated based on each account size as of the quarter end, prorated across their total accounts with me. If clients want, they can take the Roth fees out of the non-qualified accounts. Just like any other percent of AUM advisor bill, I do the same thing. Just the dollar amount is fixed as opposed to floating, quarter by quarter. Great question. Darlene also asked for me, how do you work that out with the custodian? Are you paying the custodian a flat fee? No, most custodians, or at least some, the large ones that cater towards solos or independent advisors, don't charge any platform fee. So I currently custody at TD and Schwab. TD will be folded into Schwab by the end of next year, we're told. There's no explicit charge for me. Like all custodians that don't charge platform fees, they make money by client cash balances. They pay them 0.01% and get something more than that on cash balances. They get money from directing order flow. To a lesser extent, they get money from trading commissions. Fixed income, certain mutual funds have trading commissions. But outside of that, there's no fee to me, no direct fee to the client for being on TD or Schwab platform. So the fee is the fee. $2,400 a month comes out of client accounts. That's it. There's one more here from Andrew. Jamie, you want to take this? Andy or anyone else with flat fee? Flat fee is annual, but is billing. If not, how often are clients billed?
Yeah, I can handle that. So there's a variety of arrangements, whether it's annual or quarterly. I think one of the issues to think about initially is, at least for the initial part of an engagement where there may be more upfront, you may want to front load some of the amount of upfront. But we do see quarterly and annual billing as the most frequent arrangements that we see.
Yeah, that's what I do.
We do ours quarterly.
Mm-hmm.
Mike Miller, what is your max fee for any client regardless of size? I think I heard you say you charge differently for single and married. Is that accurate? So like I mentioned, my ADV allows me to charge up to 36 grand a year. And that's just sort of a number I subjectively picked. I don't want ultra high complexity clients, but I want some discretion in case I ever feel the need to ratchet my fee up or down based on the particular client. As of now, I just leaned really hard into simplicity and ease of communication and implementation. 9,600 for married. I figured single, why not give a discount? Because generally there should be a bit less work. There's no 2 social securities to consider. You're not going to have the eventual tax planning of one spouse dies, the other one's now in a different, set of tax brackets. So I figured slightly less complexity on average, but it's still not a perfect model. There are some single clients where frankly, I do put in more time than the married folks, if for no other reason than they're just, more interested, more handholding, more questions for me. I wish, in theory, charging pure hourly makes a lot of sense, and we'll get into that in the next segment. But I leaned on more or less everyone's going to get the same resources, time, expertise from me. So let's stick to the flat fee, keep it simple for everyone. Brian asked, do fees come out of non-qual accounts only? No, fees come out of all accounts prorated, but for Roths, if clients want, we can take that out of the non-qual so as to preserve the Roth assets as much as possible. Tax deferred accounts do have their fair share taken out, which is good client benefit because that's pre-tax money. So why not? But you can't double dip and take more than the tax deferred accounts share out of the tax deferred account. Okay. What else? One other thing before we roll on, Andrew Lipman. What tax rules do you need to be aware of? I was under the impression that section 4975 allows for an IRA account to pay asset management fees without being a distribution, but not for even that same client's taxable account, and certainly not for other clients. This is correct. If you're managing 3 accounts for a client, a tax deferred, a Roth, and a non-qualified brokerage, you cannot take the entirety of your fee out of the tax deferred account. That's a prohibited transaction waiting to get caught. That's very bad. So do not take more than the tax deferred account's fair share out of it. The other accounts, you can take all of the fee out if you want to, though I don't know why you would. Like I mentioned before, tax deferred accounts have the inherent tax benefit of the money's never been taxed. So why not take the fee out of there, because it's not a taxable distribution, to your point, but you can't overdo it. Don't take out more than the IRA's fair share. Richard, I see you nodding along aggressively.
Absolutely.
Right?
Yeah. Be very careful about not taking more than a spread. That I absolutely echo that point. That could be very bad. Yes.
Yeah.
But hold on a second. It's me, Sarah Grillo. What does be very careful mean? Like, what should advisors know to practically do? How do you document it? How do you make sure that it's the right amount? What are the specific directives there that someone needs to do to be very careful?
I think there's a couple of things. You can do, and a lot of it is basically demonstrate good faith effort, right? Use some objective measure and stick with it, and document what you're doing. So whether it's the amount of work that you're doing, or whether it's even, I guess theoretically you could do it based on sort of asset size. Some objective measure that is designed to make sure that it reflects what you believe to be the amount of work that was done for that particular account, and don't go over that, and to document that. Yeah.
I'll take a stab at Alan's question. If everybody's looking at it, he's just trying to serve under the 1 million, potentially even under the $500,000 market. Feels like they're severely underserved. Can I bring services that really impact them, relative to like maybe an hourly advisor or something, and still make a living? And I think the answer to that's yes. I mean, still make a living, if we put that in air quotes, is a relative term for everyone. But, if it's a market that you're passionate about serving, I think you're going to end up creating processes, and just like Andy's probably done in his niche space. I mean, like there's a recognition of, as you start a business, can you be disciplined enough to not take on clients that don't fit the profile that you want to serve? If you stick inside that profile, I think it's like any other niche. I think you'll end up having success. It may be a little bit delayed relative to taking on, maybe a little bit delayed from a financial perspective relative to taking on anyone and everyone. But it also might not be. It depends. That's probably part of your marketing machine, how well that works. But I think you can absolutely serve that market. You just got to create processes, because what you're going to see is a ton of overlap in the challenges that you're facing. But you're right. I mean, take a look at the teacher market, for example. Teachers, firefighters, and police. They've done a nice job saving modest 403Bs and Ohio deferred comp and things here in our state. But, obviously they lack the asset size that many other folks lack, but they also have great pensions. So, I mean, that market, you can serve tons of those folks because there is such a considerable overlap between them.
Yeah. And it's possible flat fees or any fee simply isn't feasible when working with clients who are only willing and or able to pay $1,000, $2,000 a year, whatever it may be. And that's sort of the business decision I took. While I do genuinely want to and would like to help everyone, I've decided from a practical business perspective, it just can't be done, or at least not the way I think it should be done without being profitable. Just like lawyers and doctors are a bad example because there's insurance that skews this whole thing, but lawyers don't charge less simply because a client doesn't have the means to pay. They'll flat out won't work with that client, unfortunately, or have some sort of formal pro bono process in place, or can refer that client, that prospect, to another lawyer who does have lower fees or have a better process to work with, people and whatever their needs may be. So I've taken the road that while I'd like to help everyone, I can't do it profitably. And this is where percent of AUM has some benefit, although it's unfair benefit. High asset clients are in effect subsidizing your low asset clients. I met with an advisor here who's been around 20 years locally. They have 260 relationships. They manage 90 million of AUM, and they are barely getting by after covering expenses and paying themselves some nominal, reasonable wages because they have so many clients on the low end of the asset spectrum paying a few $100, a few $1,000s a year. And they give them the full suite of services, full financial planning on top of investment management. They are losing money on those clients. And if they didn't have the high AUM clients paying, tens of thousands of dollars a year to subsidize, it flat out wouldn't work. So I made the decision I just can't and unfortunately won't serve clients who aren't willing and able to pay the $8,000 to $9,000 to $10,000 per year I charge. And I'm happy to refer them away though.
Yeah, I want to add something here in terms of what Andy does is, we can't be everything to everybody. Traditionally, financial advisors have been convinced that you have to take everybody on, or you have to, a spectrum of fees, a spectrum of services. But one thing with us, again, my fee is the same way in terms of it really doesn't work for some people. And the ones who say they want it less expensive, really, there are other advisors that can serve them. Certainly we'll talk about, John's model and there's other models that only cost $100 a month for ongoing comprehensive planning. And what that really means to me is that just because I can't serve somebody one-on-one in terms of my financial planning practice doesn't mean that I can provide value. I can't provide value one to many through financial education and other resources. So Andy's a really good example of someone who he's very intentional and deliberate about who and how he serves within his practice, but that doesn't limit how he can provide value to families who aren't being served specifically by him.
Yeah, good point. Thank you.
Folks, I think we have to move on to John Luskin, who's going to talk about hourly advice. I apologize if there are questions that are not answered at the moment. There is a webinar on June 7th. I will send out the link in the follow-up to this webinar. We will continue to discuss, and you can ask questions of the subject matter experts in the next webinar, should you so desire. John, take the stage, please.
Sure, thanks. So I'll start with how to start as an hourly planner. A lot of the points have been mentioned already. LLC, register in your state. When I am registering in a state, I make sure to communicate that I'm an advice-only financial planner. Hopefully that makes the process a little bit easier. For me, get insurance, get cybersecurity insurance, make a website. But there's a lot of stuff you don't have to do. Having worked at AGOM shops in the past, with some of those shops creating their own or launching out on their own for the first time, I've certainly gone through the process of going through lots of custodian paperwork to transfer client assets. So didn't have to do any of that stuff. No portfolio management software, no custodian work, no office space, right? I just do everything remotely, so it can make it certainly a lot easier than starting a shop that does asset management commissions, et cetera. What is hourly planning? First one, let me make this distinction. So for all new clients, I do an initial engagement that is a flat fee, $17.25. So that includes a pre-document review, a 2-hour phone call, and then a write-up outlining the takeaways from our conversation. I'm going to touch a lot of subject areas during that broad financial review: Social Security, retirement planning, investing liability, cybersecurity, credit, estate planning, insurance, et cetera, cash reserves. And I do that as opposed to just doing hourly, because as other financial planners can appreciate, you need to know a lot about a client just to answer one topic. So if someone comes to me and they're like, hey, can I pay you just $3.50 an hour to answer one specific question? I tell them no, because I'm just not gonna be able to answer that question well. And I say $3.50 an hour because that is the rate that I charge if a client wants help again in the future for something not covered during the initial engagement. So $7.25 flat fee for all new folks, and then $3.50 an hour if someone wants to come back for additional help in the future. Advantages of my process as an advice-only planner: I don't have to do any implementation. For me, that's a good fit because I personally don't enjoy implementation. I don't like placing trades. I don't like doing quarterly account billing. I don't like following up a client to make sure that they purchase their umbrella insurance policy. For me, I just like being the financial planning nerd, the subject matter expert. Hey, here's what you should go do. Go do it. I like to think of it as financial planning for responsible adults. Another thing, insofar as advantages, is perhaps I'm biased having worked at AUM shops in the past, is I like the clients that I have more than the clients I've worked with in the past. I get a lot of fire folks, I get a lot of bogleheads, folks who already understand the importance of low cost investing, folks who are pretty darned financially literate. So I'm not necessarily going to have a conversation about compound interest as I am going to have a conversation about, hey, let's transfer your traditional IRA into your workplace retirement plan so we can make those backdoor Roth IRA contributions. Also, I just find that the folks I work with now are generally more grateful for the advice, and perhaps there's a correlation there. They're also a lot wealthier than the folks I've worked with at the AUM shops in the past. So, and then maybe this is advantage or disadvantage, depending upon how you look at it, a high volume. So I work with about 3 new families a week. So that allows me to get a lot of practice doing financial planning. I'm always refining my process, learning something new each time I work with some new folks. And then also another advantage, schedule flexibility, right? So I'm not necessarily on call all the time. I don't necessarily have to, oh gosh, a client email came in, now I've got to rebalance their account to make a portfolio distribution. So I've got some flexibility there. Disadvantage in that my focus is mostly on a one-time and not a subscription model. I've got to get a lot of folks to work with me now. Fortunately, there are a lot of folks out there, a lot of DIY investors who are very fee conscious, and they would rather pay a one-time fee than pay a fee recurring forever, be it that an AUM fee or even a subscription fee, right? There are advice-only planners out there who operate on a subscription fee. Eric Simonson, I believe, is going to be a guest in a future series that Sarah's going to do. He does $89 a month for individuals. He's advice only, no investment management. So Eric can wake up in the morning and he's got that $89 coming in no matter what he does. Myself, I've got to go out and make sure that I've got more folks. And another disadvantage is that since the model that I have is high volume, you're going to hit that de minimis exemption in those states pretty quickly. So I do find myself registering in a lot of states. That can be a little bit of a pain. To answer the question, what do you do if there's a large account, $50 million plus? Well, the good news is that the investment management advice is the same. When it comes to investment management, simplicity really is key, diversification, keeping those costs low. This is how I first started learning about investing, looking at how endowments, large institutions, $100 million portfolios with all the smartest guys managing that money, comparing that to an index fund portfolio. You probably don't need me to tell you what the results of that study was. If you want to fall asleep at night, you can check out johnluskin.com/thesis. So investment management, that's the simple part. That stays the same in terms of estate planning. I'll offer some low-hanging fruit strategies insofar as lifetime gifting, exceptions to lifetime gifting, front-loading 529 for kids or grandkids. But for complex estate planning, I always tell folks to work with an estate attorney. And I think that's all the points that I had on my list.
Who has questions for John? I have one. So while you're all getting, okay. So someone says a concern. Do you want to read the question?
Yeah, concern I have with hourly clients is clients not reaching out before making impactful decisions, buying a car, house for them. It's a guaranteed hourly planning cost with a more nebulous benefit. What are your thoughts about charging based under assets under management? Keep the lines of communication open. Well, good question. I think a better solution to that is going to be the subscription model, right? Again, Eric Simonson, he's got a pretty interesting model. And, $89 a month. 139 for families, I believe. So 89 for individual, 139 for families. So there's your solution to that problem right there. If that is your concern, you don't have to charge AUM, just have folks reaching out to you proactively for that sort of help. Stephen Fox, with an hourly approach like this, how do you counteract the shortfall of the opportunity for deeper financial life planning type conversation? That's a fascinating question. So to review my process, client schedules a window for a 2-hour call. They upload their documents. I look at those documents. We then have that 2-hour call, and then I send them a write-up outlining the takeaways from our call. I haven't really found that, hey, and sometimes I'll go over the 2 hours, and I haven't really found that being limited to that 2 hours says, oh gosh, I can't do life planning. So for example, a gentleman that I worked with just yesterday, he had both of his parents pass away pretty close in time. So he decided, hey, I'm going to do a sabbatical. I'm going to take some time off work. So we crunched the numbers and figured out that plan makes sense. And interestingly, he chose to work with me because he saw that on my side, I had a little bit of an about page. And I talked about my sabbatical for my family. The wife and I, we built a little van and traveled around the US and Mexico on our little converted RV before deciding to have kids. And that worked out well, and that was fantastic, and certainly would recommend. So at least for me so far, I haven't found that my process has been mutually exclusive to the life planning part. And that certainly hasn't been the only individual I've worked with respect to, doing that sort of sabbatical approach. I've certainly worked with more than one person where we've had a similar conversation just like that, crunching numbers to make sure that sabbatical approach does indeed work. Understood. Subscription model is not allowed in my state. Fascinating. Wow, that is, I'd be curious what state that is. Washington. Oh, wow. Okay. That is, yeah, Washington is that I believe, right? Having gone through their registration process, I certainly believe that. All right. Legal question: can you choose and pick whether to work on a client based on whether you would need to register in the state? Yeah, absolutely. So again, I am hitting this de minimis exemption for a lot of states pretty quickly. Initially, I had a much briefer process for working with folks. Now I've made it a little bit more involved. So now I'm working with a fewer numbers of folks that I've worked with before, but certainly that's a consideration for when I'm at that number 5 and I have a new prospect call. I let them know, hey, listen, I'm at the cap for your state. If you did want to work with me, I would have to register, and that would take some time. And I certainly have had to let client engagements be a little bit more forward in the future when I actually do get through those very state compliance processes, the registration processes. And it's going to vary by state. Some states are super easy. Some states are quite involved.
John, do you mind if I jump in real quick? If you are
please.
required to register in more than 15 states, you can actually register with the SEC instead, which is a nice benefit. So if you're right near the cap on a bunch of states, 15 or more, you can register with the SEC. And yeah, definitely,
Great.
it's helpful.
Info.
Yeah.
Make a note about that. Thank you for sharing that.
Mm-hmm.
Wonderful.
It says, regardless of AUM for SEC registration, Richard.
Regardless, it doesn't matter how much you have in AUM. You don't have to hit the 100 million or whatever figure. More than 15 states you're required to register. You can register with the SEC.
Richard Chen saves the day once again.
Yeah, absolutely.
Okay. Any more questions for John? Because if not, then I'm going to move on to Cody.
For those that are looking to refer out due to capacity issues, what are you looking for? Can we just get a referral group going in case we have some? Okay.
So my LinkedIn group is.
I'll let Sarah take it away. Yeah, please.
I mean, I have I have LinkedIn group of 100 people, and many of them are flat fee, advice only, et cetera. That could function as a referral group. There are advisors that are putting up lists. Cody has a list. Andy has a list of flat fee. I have a list of flat fee advisors. I have a list of hourly advisors. I'm going to have a list of advice only advisors. So there may be lists, but in terms of a referral group going, I mean, that's a good idea. I'll just have to think about it. I don't know if I can do it. Why don't we talk about it after the webinar? How's that? Okay, good. Any other questions? Oh, wait, oh my gosh. If a client wishes to pay monthly and your annual fee is $5,000, can you charge $420 for that monthly fee and not be a subscription?
I think that's a question for Richard.
I'm not
Thanksgiving, Kevin,
sure.
you're welcome.
Yeah. You know what? Honestly, I think, well, so Washington, that's interesting. Is the only state I've heard of that has that issue, and I doubt they define what constitutes a subscription very well. I would argue that it's not, that it is based on a specific time period, and it's just charged on a monthly basis, even if it's not. But my guess is that the states don't clearly define that. Good question. We could look into it more if you'd like. So yeah.
One more question, and then we have to move on. What is the difference between flat fee and subscription?
Well, flat fee would be one time, right? So I have a flat fee for my initial engagement, $17.25, but that is charged one time, as opposed to, again, Eric Simonson, he's doing that $89 a month. That's a subscription.
Okay.
I'll cover that a little bit in my session too.
Okay, good. Cody, let's move on to you. Thank you, John.
Cool. So in terms of time, I won't talk too much about kind of, how I got to this point, but to define advice only. So advice only is a fee only financial planning service model. Notice service model, it's not a fee model, it's a service model without the expectation, obligation, or even the option to manage client investments. So there are actually 3 fee models within the advice only service model. And those 3 fee models are project-based planning, hourly planning, and ongoing planning. So just because you're fee only, or just because you're advice only, doesn't mean you can't do one of those 3: project-based planning, hourly planning, or ongoing planning. Some people call it subscription or ongoing retainer. So the big thing is that I understand that we all serve different people differently, right? Across a spectrum of delegators. So if you kind of see a band of delegators and DIY do-it-yourself investors, the traditional financial advisory industry has only really been serving delegators or specifically trying to convert DIY investors into delegators throughout their process. John and I really believe that individuals and families can successfully manage their own investments. When people ask me, should I manage my own, when should I hire an advisor to help me manage my investments? I use the 3 T's, which is, do you have the time, the temperament, and the talent to manage your own investments? But there's actually 2 things there that are big misconception, and kind of what the advisory industry has thought is their secret sauce. It doesn't take that much time to manage investments, regardless of what advisors tell you. I've talked with people who manage actually over $1 billion in AUM. They say they spend on average, 3 hours a year managing somebody's investments in terms of the technical management. Again, think about implementation differently than planning. Like figuring out what to sell, what to buy, how much to convert, that's planning, right? The implementation is what matters here. So I separate planning from implementation, how I think about advice. Another thing, it doesn't take very much time to manage investments. I spend an hour a year managing my own investments. I know that I have the knowledge, but again, that's a whole other thing. And the talent, it doesn't take that much talent to manage investments. And again, here I'm talking about the talent to implement the investments, not the talent to actually figure out how to implement. So that's my role as a financial planner, is to help people understand what to do, how to do it, and most importantly, why they're making their own well-informed decision in alignment with their family's unique values and desired outcomes. So again, advice-only planning, because I don't manage investments, I'm specifically working with people who believe they have the time, the temperament, and the talent to technically implement their own investment management, but they want to work with me to have guidance of the dozens of other financial planning areas outside of investments. So I have outlined 88 planning topic areas that I cover in planning. The average client, I educate about 25 of those topic areas. Only 5 of those 88 planning topic areas have anything to do with investments at all, right? So I'm really educating consumers and other advisors that financial planning is not just investment planning, right? There are so many things that people want to come, figure out. They say, hey, Andy's a great example of this. He talks all about, hey, when should I take Social Security? How much should I convert to Roth? Talking about the balance of pre-tax, taxable, after, tax-free asset tax location. Hey, I have this concentrated position in my investments, right? So should I prioritize conversions or that? So again, insurance, estate planning, there are so many areas. When you tell somebody you're a financial planner or financial advisor, they immediately assume what you do is choose stocks and bonds. So advice-only financial planning is changing the perception of what financial planners actually do. Even AUM planners do a lot of financial planning, but the fee model itself actually communicates to consumers that the value of financial planning is somehow correlated with what the stock market's doing. So, in the fee only, in the flat fee and investment and advice only models, we're specifically telling clients the value of our services is in the financial planning, not just the implementation. So the advantages of advice only financial planning, first of all, I think about what's the advantage for the consumer, right? So it finally provides comprehensive financial planning to people who haven't been traditionally been served. When I launched my firm, actually, at my last firm, thank you, Benjamin Barron, super clear. That's why you got to buy a nice microphone. So at my last firm, a prospective client called and they said, I have interviewed 10 fee-only CFPs, and not one of them will provide comprehensive financial planning without the expectation to manage my money. So most financial advisors see financial planning as a loss leader, as really just the natural gateway to charging rent on people's money. They'll say, hey, yeah, we'll do a financial plan, but really the whole purpose of that financial plan, just like the insurance industry, lets the product lead the plan in terms of selling an insurance product. A lot of AUM advisors are just, advisors that manage money and are compensated that way. They're letting the implementation of the investments, that product lead the plan. I do believe that implementation is a product, just like selling insurance and investment products. So the advantages, it serves people who haven't been served. Another advantage is without managing investments, guess what? I don't have to work when the stock market's open, right? So you think about like the control command over my time, my calendar. There are no emergencies in my business. Nobody calls me and says, make this trade by the end of the day. I communicate within 48 hours, but there's no emergencies in my business. When people tell me there are financial emergencies, they're usually things that actually you shouldn't be making any fast financial decisions. Someone says, well, what if their spouse died, or what if somebody in the family died? Like, that's a family emergency, but that's not a financial emergency where we're going to make some implementation changes super quickly. So another thing, I don't have a phone in my business. I don't think that you can manage investments and not have a phone in your business, I'm guessing. Any compliance feedback on that? Do you have to have a phone in your business if you manage money?
Do you have to? You don't. Yeah, but yeah, there's no requirements. Yeah. Okay.
But the thing is, you can't. I guess the client cannot. They would have to talk to you on the phone before you can make any discretionary, or any investment. So actually, besides the investment management part, not having a phone in my business also, it lets me have really my time for deep work. I'm not distracted by phone. I just have a lot of flexibility. Zoom calls and emails only. Another thing is compliance is simplified. Like pretty much I bet the word I see most often is in my ADV is no. When I fill out my ADV stuff, it's like, do you do this? No. My ADV should be 1 page long. I don't know why it's over 20 pages at this point by being advice only. Another thing, simplicity. Andy talked about. I charge every client the same fee for the same service and process, right? I don't have to talk about my service, my process, or fee on my intro call. I can just talk about the clients. I can just learn about their family. Simplifying fees in any way is great for the clients. It's great for really communicating the service that I provide. That this is a relationship-based business, not a transaction-based business of you pay me, I do it for you. You pay me, I tell you what to do. It's a collaborative relationship that starts with transparency and generosity. The only disadvantage I really see of being advice only is that some clients do need ongoing investment management, right? It's not that they don't have the time, but they might not want to spend the time managing their own investments, however long it takes. Temperament, that's the number one reason somebody would want somebody managing their investments for me. That disadvantage is, it's kind of like an interview. You turn that weakness into a strength by saying, if somebody at the end of the planning with me says, hey, I actually think I do need ongoing accountability, I simply just refer them to another financial advisor that provides that service. If somebody needs ongoing investment management, I refer them to a flat fee advisor who offers, with investment management, or an advice only financial planner who doesn't do investment management. So I don't see any competition in this space as an independent RIA. And yeah, I'll end it there since we're close on time.
Cody, if you don't mind jumping in real quick, I would
Sure.
say if you knock out investment management from a compliance perspective, you probably knock out at least 50% of the time and obligations from your compliance, at least from an SEC perspective. I would say it's at least 50. We just had an arrangement where someone said, we're not doing any trading. We said, we'll offer you services at a lot lower rate. So it is a huge benefit from a compliance perspective.
Yeah, I'm actually like kind of hoping for an audit. They're going to be like, tell me about what are you doing with their investments? I'm like, I don't manage investments. And they're going to be like, okay, I guess we'll just leave and go audit somebody else now. So quick questions. Sarah, do I have some time for some questions here?
Of course you do. Yeah, go ahead.
Okay. So Andrew says, Cody, do you have a separate single versus married rate, any family rate? No, again, simplicity. I really like what Andy said about kind of, he actually like, you know, he actually knows why he charges married people more than single, right? Because there's certain there's certain documents that he has to view doubly and things like that. But at the same time, I don't believe that complexity in terms of being married versus single is any different from a single person with 2 jobs or a married couple where only one works. So again, simplicity and transparency, one fee regardless of. So I work with people with 500,000. 8 million, people who make $1 million a year, people who make $50,000 a year, they all charge the same fee for the same service and process. And they kind of ultimately, they kind of filter themselves in. And I only work with people who want to be work optional within the next 5 years or in terms of early retirement. So, you know, when you define a niche, it's very easy to ultimately work with who you want to and not have your fee be the dictating factor on who you serve. Cody, since you charge an upfront fee and then optional subscription, I do not charge an optional subscription going forward. Let's see. So how do you address clients that feel? Okay. So yeah, a great misconception about the one-time plan, this project-based planning. A one-time plan doesn't just have to happen once. So I don't offer any ongoing monthly subscription model, but what I do is, so I charge $6,400 for the first comprehensive planning engagement. Every time moving forward, if they want to go through a comprehensive plan engagement with me, it's $4,800. So it's 75% of the cost. If somebody wants to do ongoing in a way, they can just reach out to me once a year to update the plan. So that's my way to do ongoing without first having I want control and command over my time. I take all of December off every year. I literally have no clients, no revenue in December, but I've intentionally done that because I want, if I had ongoing planning, I would have to be, you know, even on vacation or whatever, I'd still have to kind of check in to make sure that I'm serving clients ongoing. So I don't do ongoing subscription, but I do provide services to people who want to work ongoing on an annual or less often basis. What kind of insurance do you have as advice only? I have E&O insurance. So a big misconception is I still have to be registered as an RIA since I provide investment advice for compensation, even if I don't manage investments. So in terms of insurance, I still have E&O because I'm still giving that investment advice. I'm still covered by my E&O and, you know, providing advice. And I also have the cybersecurity insurance as well on top of that. What about clients doing rebalancing, distribution, tax gain, loss harvesting? Do clients have a hard time doing that trading? So another misconception about advice only, just because I don't implement investments, I'm not the one pushing the buttons. It doesn't mean I can't teach somebody how to do it in real time. So I'll actually screen share with clients and show them how to implement their own rebalancing, distributions, tax gain, loss harvesting. I can teach them how to view their cost basis, realized, unrealized, whether it's Fidelity, Vanguard, M1 Finance. It's actually great for me because I learned how to use all those platforms along the way. So I'm really helping, you know, I'm teaching a man to fish, right? I don't just say do it and don't teach them how. I use a whole month out of my engagement is focused on helping them implement those decisions themselves. How about one-off questions after you're done with a plan? So yeah, there's a 3-month engagement. I finished the comprehensive plan presentation within 2 months. They have an additional month to gain what I call the clarity and the confidence to actually implement now their well-informed decisions. If they have questions ongoing, in my ADV, I actually have the option for hourly, but at this time, if they have a quick question kind of thing, yeah, like I can just kind of answer it for them. if they want, if 6 months later they say this big thing happened, can you answer these few questions? I'll just engage in another, I'll just create another scope of engagement. So I think it's kind of a limiting belief for people to say, well, what if they have a question, like in 6 months or something happens, like they just reach out and we can create a new scope of engagement, whether it's limited or fully comprehensive. But I think that's all my questions. And I don't do any hourly at this point.
To add on to that other question from iPhone, what about doing rebalancing, et cetera. For those folks who do want additional help in doing that rebalancing process, I can provide them the exact trade orders. Hey, buy this fund in this account, sell this fund in this other account, keep this fund because it's low cost and it's diversified and you don't necessarily need to realize the taxable gain. So for folks who do need that extra help, I do provide that additional service.
Oh, I see that one question there. How often do your clients return for an annual offering? I've only been in business and doing advice only planning since June of last year. But I started doing conference planning before that. So upon plan presentation, most clients say, well, how do we work together moving forward? I would very confidently say 4 out of 5. We'll continue doing an ongoing annual engagement. And then kind of the 1 out of 5, we'll either kind of take it from here or come back every few years as things change.
Yeah, and add on.
Yeah.
Oh, go ahead.
Oh, sorry. Another question. What would you say to advisors who worry about this might prohibit a long-term relationship? Great question. I believe that the sustainability of financial planning is not in the fee model. I don't think the fee model really is what's sustainable. It's building the relationship that's sustainable. People tell me all the time that advice-only financial planning, especially doing project-based planning, like how is that sustainable? You're always having to find clients, but that's like having a truly educational financial planning approach. Where, I mean, I spend 20 hours on a financial plan, 15 developing, 5 hours with the client, building that level of relationship. That's way more sustainable to me than some type of ongoing AUM percent, some type of fee model. That's kind of, people talk about having AUM as like, because they like that it's a lack of friction. It like keeps people clients because it's like a lot of work to not become to not become a client or to turn away from becoming staying a client. But I think the sustainability is in the relationships that we're building. And I refer away about 20 clients a week that want this and can't get this because the demand exceeds the supply. Go ahead, John.
Had to unmute myself. Yeah, there's another advice only advisor that has a similar model as myself. And I just mentioned that because I've only recently launched since August. So my metrics for returning clients are, let's say, that valuable data set. But I certainly have had some clients come back engaging me for the hourly rate. Again, maybe it's helped with that trade orders. Had a lady who's setting up a 401k, moving from a simple IRA. So I helped pick the investment menu and let her know about the Rule 55 and the mega backdoor Roth process. And then I had another gentleman come back. He found he had some health issues, and we had that bigger life planning talk about how to run the numbers, figure out retirement planning. Is that possible today? So 10% for that other advisor who's doing an exact similar model as I am, upfront fee and then hourly thereafter. And I've had a small number of folks come back to work with me since launching my own firm in August.
And one last question came up about, so anybody engaged in insurance sales? So as an advice-only financial planner, I just stay in my lane and I create a network of trusted professionals. So anytime I see a need, what's great about it, right? I see a need for life insurance. First of all, I don't have to I'm not compensated by that recommendation, but also the client is much more likely to actually implement that insurance need because they know, they're like, well, Cody wouldn't have told me to get life insurance if I didn't need it because he's not, there's no conflict of interest there. So when somebody needs illustrations, if somebody needs, different quotes, I just have a trusted network of other advisors that will implement exactly what the client needs based on their financial plan.
Same for me. I believe all of us on this call are fee only, so inherently no securities or insurance sales licenses, and that was a conscious decision for me. Not because life insurance or life insurance products such as annuities aren't important. They are, and they are the right fit in the right set of circumstances. But my view, and I think most folks here, the view is that you can't be all things to all people. Insurance in particular, very constantly evolving, lots of new shiny objects all the time. You have to really be in it to fully appreciate and know the best product. So advisors often think, how could you not sell insurance, right? You're not a real advisor. Well, why don't advisors say the same about doing estate documents for people, or doing people's taxes, or selling Medicare supplements or property and casualty insurance, right? Getting off on a tangent here, but I think historically financial planning kind of spawned from life insurance sales. So there's this kind of inextricable tie to think you have to have this to be doing this. Not the case. So work with people, have knowledgeable expert network, or even fee-only platforms like DPL has them. The major insurers, Nationwide, Jackson, Lincoln, all have fee-only platforms where you can help the client search for, find the right insurance product, and then when it's time to consummate the transaction, the in-house agents at those platforms will be the ones to actually sign the thing. So that's my perspective.
There's a question about when does AUM ever make sense in all of your opinions? So implementation, having an advisor help them with implementation makes sense in my opinion, but I won't refer to an AUM advisor at this point. Anybody else's feedback on, do you ever think AUM makes sense? I guess, first of all, do you think it makes sense to, for them to need ongoing like investment management? And then do you refer to any AUM advisors?
I don't. I mean, it makes sense for the client at small asset sizes because it allows them access to the advisor. But from a business perspective, I feel as firmly that advisors shouldn't be overcharging. They also shouldn't be undercharging. Don't give away your services for $1,000 a year if you're doing comprehensive investment management and financial planning. Just that's why I chose not to do it. So it does close out a large part of the consumer market. So I don't think it makes sense unless someone's got really small assets, and I know some other percent of AUM advisor are willing to take on such a small engagement, which is likely subsidized by a client paying higher fees.
Hey Andy, one quick thing there that's so valuable is that all of our models that we've been talking about, we don't have A, B, and C clients, right?
Correct. Yeah.
So like this makes a good. It's not about compliance. It's about really treating in terms of equality within who you're serving. Like we don't have this like, oh, well, they don't have very much money and they're not paying me very much, therefore I'm not going to spend as much time, or, oh, I'll get to their email later. I'm going to respond to the email from my big client first. We don't have that issue with the way we fee.
And to answer bluntly, when percent of AUM makes sense, I'm going to be real snarky, but painfully honest. It makes sense for established advisors who want to go really win at capitalism, really wring as much revenue as possible out of clients, institute a $1 million minimum, charge 1.5%, 2% just because they can, and just crush it, make a lot of money. It makes sense from that business perspective. That fundamentally sits really, really wrong with me. And I'm not.
You mean you don't want to brag about it on Twitter?
No. I don't know. Yay for capitalism. I'm all for capitalism, but I see a terminal value on this stuff. Whether you got $1 million, $3 million, if you're an average complexity, you should not be paying 20 grand a year. It's just, people are going to be like, who the hell are you to say what this is worth? I'm saying financial planning, the value in it is really opaque, really nebulous. It's hard for clients to figure out what it is. Just because they're willing to accept the $20,000, $30,000 fee you put in front of them doesn't mean it's right, doesn't mean it's justified, just means you both mutually consented. Anyway, I'll stop now. I'm going to anger people and get death threats,
So I've got a different take, and I'd be really open to the other folks on here trying to convince me otherwise. But for me, it's not necessarily that AUM is the problem. It's that 1% AUM is the problem. Now, normally AUM is synonymous with 1% or heaven forbid something higher. But for those folks that I do work with during digital engagement and we talk about managing their portfolio, sometimes it's not going to be right for everybody. So the solution then isn't go pay a high fee advisor. It's let's go find a low cost way for you to get your money managed. So some low cost investment options that I discuss with folks where it's just not appropriate for them to manage their money because again, they don't have the time, the temperament, or the talent to use Cody's excellent verbiage. We talk about using the different low-cost options, and then the pros and cons of each of them to help them decide what's appropriate for them. So we talk about Betterment's low-cost model. We talk about Vanguard's low-cost model, and then there's an investment manager. He'll charge 0.25% for just asset management. So that can help them decide if that is going to be something that's appropriate for them.
I have to end the webinar now, everybody. I wanted to talk about marketing, but I can't. But I just want to tell all of you that on my website, there's a sheet called, how do I even spotlight myself? I don't even know anymore. Oh, here I am. Replace pin. Hold on a sec. Oh, well, what the hell? Pin. I'm pinning myself. Oh, okay, because I don't have a thing.
There we go. There's
okay,
a leopard.
That's me, the leopard. So, okay, everybody. So here, I just want to tell you all one thing, okay? That you should be doing go to the marketing resources page for flat fee advisors on my website. Go to my blog, if you type in the word panko, okay, then two things are going to come up. The podcast I did with Andy, and then the marketing resource sheet for flat fee advice only hourly. Okay. 1, SEO your website, meta descriptions, keywords, flat fee advisor in X location, blogs. How much does a flat fee advisor charge? Questions to ask a flat fee advisor. Okay, all of this is explained there. I think it's important that you understand that there is search volume for these keywords, and that if somebody finds you through Google, then that's kind of like making Google your free salesperson. You don't have to do any work. You establish the blog, you fix up your website, and then hopefully Google can just send you in. So really important to get your website, and you don't have to hire a big web developer or anything. If you go to Neil Patel, there's Uber Suggest, which is a free keyword research tool. You get 3 free searches a day. You can follow Neil Patel's basic guidance. It's not rocket science. You can post questions into our group about how to SEO optimize your website. That's definitely something that you should be doing because, like I said, it's a cost-effective way to get traffic sent to your site. There are other like LinkedIn tips that I would give about how the LinkedIn algorithm works, et cetera, but that's a little bit more of an involved discussion. I could just tell you that the traffic is out there and your website should be optimized for hourly advisor in X location or flat fee advisor in X location on your homepage, in the meta terminology that's on the back end of your website, and in the blog section of your website. Also in your bio page, Mary is a flat fee advisor in Boise, Idaho. Okay, really important, and most of all, it can be free. So, okay, I'm going to end the webinar now. I want to reinforce some important concepts here. One, on June 7th, we're having a webinar with Scott Solaski and Eric Simonson about how to serve clients with dignity as flat fee and advice only. So it's going to be a continuation. I hope that we'll see you all there. And I'm hoping like maybe to make this into an either quarterly or monthly series where we just I just want to support the movement. But I can't support you unless you support me in giving me questions. I need the questions, everybody. I really need your questions. And the reason is I want there to be a strong, solid resource that anybody who wants to pursue this can come to this and say, here are people who have done it. I don't have to reinvent the wheel. I want to provide not shortcuts, but I want to make it easy for people to do this. But I can't make it easy for you unless you tell me what's hard for you. Okay, so I need you to tell me what the questions are. I can organize it informationally. I have a LinkedIn group. I have a newsletter. I have on my website, I published about this. I know how SEO works. We can really change things. We can make advice affordable to people. We could give the industry a better reputation. We can avoid people being ripped off. We could do all of this. I mean, we could really change things. All right. So, and I want to be the one to really kick it in. Okay, I want to be the person to do that. So help me help you, in other words, by just communicating with me any challenges you have. I'll keep a tally, organize it, and disseminate it to our our participants. Okay. And having said that, I have to end the webinar. So June 7th with Scott and Eric. This is the sign up. I'm going to send that out. And that's it. I'm ending the webinar now. Okay. Peace be with all of you. Bye.